Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Have you ever wondered why two people with the same income can get completely different loan offers? The answer often comes down to three little words: your credit score. Today we're breaking down exactly what a credit score is, how it's calculated, and why it can make or break your next loan application. A credit score is a three-digit number that summarizes how trustworthy you are as a borrower. Lenders use it to predict the likelihood that you'll repay a loan on time. The higher the number, the more confident a lender feels about lending you money. So, how is this number actually calculated? Most credit scoring models look at 5 key factors, each weighted differently to build your final score. The single biggest factor is payment history. This tracks whether you've paid your bills, credit cards, and loans on time. Even one missed payment can stay on your record for years and pull your score down significantly. Next is credit utilization, which compares how much credit you're using against your total available credit limit. Maxing out your credit cards signals financial stress to lenders, even if you always pay on time eventually. The length of your credit history also matters. The longer you've responsibly managed credit accounts, the more data lenders have to trust your habits. This is why closing your oldest credit card isn't always a smart idea. Credit Mix looks at the variety of credit types you manage, such as credit cards, car loans, and mortgages. Handling different types responsibly shows lenders you can juggle multiple financial obligations at once. Finally, new credit inquiries matter. Every time you apply for a new loan or credit card, a lender checks your credit report. Too many inquiries in a short period can make you look desperate for credit, which lowers your score. Credit scores typically range from around 300 to 850. A higher score usually unlocks better loan terms, while a lower score can mean rejection or far more expensive borrowing costs. It's worth knowing the difference between a credit report and a credit score. Your credit report is the detailed history, listing every account, payment, and inquiry. Your credit score is simply the number generated from that report, designed to summarize your risk level at a glance. So why do lenders care so much about this one number? Because it's a fast, standardized way to assess risk. Instead of manually reviewing years of financial behavior, a lender can glance at your score and estimate how risky you truly are. This number directly impacts whether your loan application gets approved in the first place. Banks often set minimum score thresholds, and falling below that line can mean automatic rejection, regardless of your income level. Even if you're approved, your credit score shapes the interest rate you're offered. Borrowers with excellent scores might qualify for the lowest rates available, while those with poor scores could pay significantly more over the life of a loan. Imagine two people applying for the exact same car loan, borrowing the exact same amount. One has a strong credit score and locks in a low interest rate, paying less over time. The other has a weak score, gets approved, but ends up paying thousands more in interest across the life of the loan for the exact same car. The good news is that your credit score isn't fixed forever. It's entirely possible to improve it over time with consistent, disciplined habits. The most powerful thing you can do is pay every single bill on time. Payment history carries the most weight of all factors, so consistency here creates the biggest long-term improvement. Next, try to keep your credit utilization low. Using less than about a third of your available credit limit is generally seen as a healthy sign by most scoring models. Finally, avoid applying for multiple new credit lines in a short span of time. Space out your applications and only apply for credit when you genuinely need it. It's also worth building the habit of checking your own score regularly. Reviewing it lets you catch errors early, spot signs of fraud, and track whether your financial habits are actually moving the number in the right direction. Understanding your credit score puts you back in control of your financial future. It's not just a number, it's a key that can open doors to better loans, lower interest rates, and greater financial freedom. This video is for educational purposes only and is not financial or investment advice. Always do your own research or consult a licensed professional before making any financial decisions.